Currently, Warren Buffett's net wealth exceeds $100 billion, but this wasn't always the case. The market capitalization of Warren Buffett's business, Berkshire Hathaway, is $660 billion. His investing portfolio had formerly included relatively small quantities of money. When Buffett was in his 20s and 30s, his career's biggest returns were produced. That's the power of investing small amounts of money, which Mr. Buffett himself always recommends. And in this video, we're here to tell you how to do that and why you should take this tip seriously. Let's simply suppose that 10% of the total worth of the firm must be invested for an investment to have a significant influence on the company's performance. To reach that 10% barrier, the investment would need to be valued at around $65 billion or $70 billion. Let's take a look at some businesses that are currently valued in that region to put that into perspective. General Electric, one of the most recognizable firms in the world, is presently valued at over $80 billion. At this time, Airbnb is worth $70 billion. FedEx, a firm that delivers packages, is presently valued at $61 billion. Ford's market worth is $58 billion. Marriott's current market worth is $52 billion. Therefore, each of these businesses is enormous. However, for Buffett to have a genuinely significant influence on Berkshire Hathaway, he would need to purchase one of these enormous businesses, or as he puts it, make an elephant-sized acquisition. This reduces the number of prospective businesses Berkshire can meaningfully engage in. As Berkshire continues to grow, Buffett's pool of potential investments becomes fewer and smaller. Let's use the same 10% threshold and claim that an investment qualifies as significant if it accounts for 10% of the investor's net wealth. This investor's array of investable assets is limitless. There are only 98 shares of this corporation in existence. The investment in the Delta Duck Club, which Buffett discusses, began as a hunting club but swiftly evolved into a business when it was discovered that the property the club members held contained significant oil underground. You are effectively paying $9,000 for an investment that generated $11,000, and after-tax profit for you in the investing world, after deducting the $20,000 in cash from the $29,000 purchase price of the share. Only 0.000004% of the company's market worth would be invested if Berkshire had purchased this today. Since this investment represents such a small part of Berkshire's wealth, it would be practically pointless. It wouldn't even be worth Buffett's effort to make it. An investment in Delta Duck Club, on the other hand, would be fantastic for an investor whose whole investment portfolio is $30,000, since it would account for a significant amount of his net worth. This brings us to the second benefit of making tiny investments. In the realm of equities, generally speaking, there are more investors attentively monitoring the firm as it grows in size. The likelihood of the stock being cheap decreases with the number of investors who watch it attentively. There are, of course, exceptions to this rule. However, this position holds up generally. Use Apple as an example. Thousands of knowledgeable investors regularly monitor Apple's stock, and many of them attended prestigious colleges and worked for some of the world's most well-known hedge funds and investment banks. It attracts a lot of attention, and a lot of intelligent individuals keep up with the business's every move. Contrast that with a company that is only worth $100 million. Just because of its lesser size, this stock will automatically attract less investor interest. Compared to a huge corporation like Apple, this stock probably has a much smaller fan base. The less competition there is, the better if your objective is to identify inexpensive stocks. Therefore, Buffett's first bit of advice is to observe other individuals. In investing in businesses that are just too little to be significant for investment firms with billions of dollars, the US has always had a significant edge. According to Warren Buffett, he would concentrate on smaller businesses if he were in charge of a considerably smaller sum of money. Many excellent businesses across the globe can be underestimated in comparison to those in the United States. Other reputable investors, including Peter Lynch, agree with this statement. Lynch created the phrase 10 baggers, which refers to investing in a company that increases in value by a factor of 10 from the moment the investment was made. The ambition of every investor is a 10 bagger. He has discussed how much simpler it is for a tiny business to 10x than it is for a big one. It seems to reason that a corporation can increase its sales from $1 billion to $10 billion considerably more quickly than it can increase its sales from $100 billion to $1 trillion. It becomes more difficult for a corporation to continue expanding at the same pace as it grows. The next piece of advice is to consider a market that is considered to be inefficient. In an inefficient market, the price of an asset does not fairly represent the worth of that item. Using the example of a market that is not efficient is the greatest approach to illustrate it. You may purchase subpar real estate in the Midwest of the United States and pay to have it rehabilitated. An example of an ineffective market is this one. If you purchase a home for $80,000 and spend $90,000 renovating it, you finish up with a property worth $170,000. However, the house is worth $280,000, so you make a profit of $110,000 on your $110,000 investment. There are many more allegedly inefficient markets, of which this is only one. Well, what did you learn from these? Post your comments in the space provided below. Thanks for watching.